Welcome to the multifamily investment package and underwriting tutorial. So the goal of this session is to walk through how to utilize the multifamily underwriting tool. The goal of the tool is to be able to provide a sleek and seamless tool to allow investors to quickly and easily underwrite multifamily buy, renovate, and refinance deals. So generally, when multifamily investors are purchasing properties, they're looking for maybe distressed properties or properties where value can be added or repositioned. This model is ideal for investors who are looking to reposition multifamily buildings, add value, and then ultimately refinance that value that's been created out of building. However, it also has capabilities to underwrite deals that are just simply buy and hold multifamily deals, etc. So just to start off, to preface that this model should not be used as investment advice. It should not be solely relied upon for any underwriting of deals. It's ultimately up to the user to gather all of the appropriate inputs, validate that the calculations are being done appropriately. It's more of a tool to use to do a quick analysis on an investor side, but all analysis shall always be underwritten. Now that we've gotten that administrative piece out of the way, just to give you a quick overview, the way that the tool is structured is that it's broken down into various modules. However, there are only one place where all inputs are entered into the model, which would be these two green tabs, which I'll walk through in detail later. Once these two all the inputs are put in, the model will automatically generate all of the other tabs and all of the other modules that need to be created, and which is quite convenient. And the way that the model works is it's very dynamic. So as you need to tweak assumptions, all of those that adjusted assumption will flow its way through the entire financial model and then recreate all of the tables and diagrams and graphs and stats that are calculated within the model. So ultimately, at the end, you'll also be able to generate a very sleek PDF package, such as the one over here, to be able to actually quickly present your deal to any partners, even have it sort of for yourself to be able to understand what variables need to be adjusted to make the deal profitable. So, I mean, what it will generate is a quick executive summary showing you an acquisition summary, your renovation budget and timeline, the property income at acquisition and refinance, and how your refinance proceeds will be distributed out, mortgage principal, cash flow after 5 years, cash flow after 10 years, mortgage principal after 5 years and 10 years, a quick investor summary, basically summarizing the full deal, which I'll go through all of these in a lot more detail later in the module, a full 5-year forecast of all of the investment returns, a 10-year projected property profit and loss statement, showing a breakdown of how each one of your line items will grow or be adjusted over a 10-year holding period. You can do this at a 5-year holding period as well, and how each of your operating metrics will change over a 10-year period. Quick summary of some investment statistics, some graphs as well showing debt service coverage ratio, and then also the ability to pop in property pre-renovation images and post-renovation images as well. Not only in addition to that, there's also a few very additional modules that are included in here, which are quite useful to multifamily investors, which would also include a profit and loss statement during your prior to your refinance, a investor summary if you're just going to use this as a buy and hold statement. It will also automatically generate your amortization table for your pre-refinance mortgage and your post-refinance mortgage. So post-refinance mortgage being here and pre-refinance mortgage being here. And I'll go through these in a lot more detail throughout the session today. And one interesting thing that I've never seen done before is a summary for a vendor take-back mortgage, which has become more and more common in underwriting multifamily deals, given where interest rates are at. So what it'll do is it'll generate a summary showing your the vendor who will be providing you with a vendor take-back mortgage an idea of what his return will be. So it'll generate a quick VTB mortgage interest schedule showing the vendor how much he's making on interest on his vendor take-back mortgage that he's advanced you. In addition to that, it will also provide the vendor a quick summary of the tax benefits that he'll experience as a result of deferring his capital gain on the deal by advancing you a vendor take-back mortgage. As you know, there are some tax advantages to providing the seller with a VTB mortgage that not all vendors would be perfectly aware. I'll go through this in a bit more detail, and then ultimately, even it will provide him a quick summary of the commission that he'll save by selling you the deal off market, if that is an option to you. Some other items that we have included here is a quick summary of terms and conditions that you may want to include in your deal when making an offer. There's also a due diligence checklist on all required documents that will generate, like just a quick and dirty list of documents that will likely be required to underwrite a multifamily deal and actually get your financing in place. So without further ado, I think we'll start with actually going through how to use the model, and subsequently we will then go into all of the tabs that will get generated as a result of underwriting. So like I said, the green tabs in the front over here are your input tabs. This is your key executive summary. This might be something that you might even want to print out once you're done, just to have all of the underwriting assumptions that are involved in a multifamily deal. Now, as you can see, there's quite a bit in here, but it's very, very simple to use once you go into the details. So ultimately, any blue cells in here are input cells, or cells where you can enter notes. Those are basically areas where you'll want to input data or information pertaining to the property. Any white cells will be calculation cells, which ultimately will mean that you won't need to enter in any information in those cells. Those are more so cells that will just automatically be calculated. So the first step in underwriting a multifamily deal is really to get to the property's rent roll and the property's current financials. So generally, this will be provided by the vendor, and it's ultimately up to you as the purchaser to validate that the financials are accurate, whether that be through an audit or whether that be through you getting all of the supporting documentation to support the property financials. So the beginning step here is there's this property rent roll tab, where we will enter in the property's current rent roll, which will include this example property here that I've included is 464 King Street. The property is a 11-unit property, mostly consisting of 2-bed, 2-bath units. And basically, for simplicity, we're just going to assume that the leases all have the same expiration date. They're all on 1-year leases. And the next step is to, and this can also be used as a tab in your presentation to potential investors or underwriting, depending on the level of information you want to see. But the best part is it's all in one place, and it's ready for you to quickly pull out if your potential investors or partners ask, okay, what does the current rent roll look like? Well, you'd already have entered it in over here when you underwrote the model. So as you can see, I've entered in over here the monthly rent at acquisition. So this is the current rent of the property on the day that you acquired it. So what the current tenants are paying at the property. You can see there's some tenants that are paying close to market rent, some tenants that are paying well under market rent, and some tenants that are paying just above market rent. The next step is, and basically this would be the monthly rent amount, which will automatically be calculated and converted into an annual rent amount to put into your property profit and loss statement. The next step is to enter in what you think you can turn the rent will be on those units at refinance. So let's say I think that I'm able to, the market rent for units in this building is actually 1550. I can turn over these units quite effectively through negotiations with the tenants, through negotiations with through just natural turnover in the building. So what I have entered in here is what I believe the market rent will be once I refinance this building after a repositioning period on the building. Now, ultimately, in a realistic scenario, you may not be able to get top market rent for every single unit at the point of refinance, but maybe you'll be able to turn over 50% of units and reset them to market rent, or 20% of units, 40% of units. That's ultimately up to you to enter in here as to what you'll be, your monthly rent amount will be on refinance. So then once that's calculated, it'll calculate out what your annual rent will be currently and your annual gross rent at refinance. So once this is all complete, you will go to the next tab. So it's broken out into various sections in the one-page deal analyzer tab, where we'll start by entering the property address. That'll just get plugged in by you, the number of units. The unit revenue, rental revenue, will automatically be pulled in from the property rent roll tab based on what the market rents of the unit are today. Next, there's also a section here for auxiliary revenue. Maybe the property has parking revenue, locker revenue. This property in particular has about $3,800 in laundry revenue. So that's just entered in manually. There's also some spots here where you can manually enter in other revenue. Maybe there's like pet fees. You can enter in other types of revenue that you may be able to charge back to the tenants. And then you can enter in the annual amount that you'll make off that. So if I've given you 1, 2, 3, about 4 additional revenue spots where you can plug in the annual amount of revenue that you be earning there. And then also notes on, you can enter in notes for each of these line items. For example, like plan is to increase unit rent to market rent. These are just for yourself to go in and just kind of put notes in on what you think you can do on this property, or maybe provide notes to partners or something like that. The next step is you'll enter in your property's vacancy rate. So this will be the vacancy rate that you'll utilize for your underwriting assumption to get your initial financing. So the goal of this section here of building out this P&L is you may get the actual profit and loss statement from the vendor. However, you'll probably want to actually underwrite these financial statements as if you were the lender on the acquisition, so that you can actually calculate things the way that the lender will calculate it. So generally, the property may not have any vacancy at the moment, and but you'll know that the lender will enter in a 2% vacancy. Now, I've entered in some notes here on how CMHC or a conventional lender will underwrite a specific deal. For example, a conventional lender will generally take about 5% vacancy, even if you have no vacancy at all in the property. CMHC will utilize this module over here where you can enter in the property address and it'll tell you what the CMHC vacancy rate is for that property. So there's a bit of a variance in how the property's vacancy rate is calculated. I would suggest you work with your specific lender or mortgage broker to have them explain to you what you should be utilizing. But in this particular situation, I know that if you're underwriting with CMHC, I'm just going to use 2% for now, probably maybe closer to 5%, but we'll just use that to ultimately get to our effective gross income, which is the gross revenues minus the effective minus the vacancy rate. Now, next, we're going to move on to the next section where we're going to enter in the operating expenses on the property. So property taxes, this one's pretty basic. That'll generally be on the listing of the property, or you probably want to also get a copy of the most recent property tax bill to underwrite that assumption. Property insurance, you can use that from probably you can use that from your the property's current financials, or you might want to contact your insurance broker to get a quote for what they believe they'll be able to provide you in terms of rates on this property. Maybe there's some opportunity there. Repairs and maintenance, again, conventional lenders will usually underwrite you around 4 to 5% of effective gross rent. So this is entered in more as a percentage. However, if you wanted to overwrite this formula over here, you can enter in a manual amount, let's just say like $6,000 annually. But ideally, you'd want to enter it in as a percentage. Like, for example, CMHC sometimes will underwrite deals at $600 a unit for buildings under 7 units and $800 to $900 a unit for buildings above 7 units. So you may want to use that assumption as well. Again, it's up to you to understand how the conventional or how the specific lender who's going to be providing you your mortgage will underwrite this, at which point you can tweak these assumptions. I've just entered in some notes here to have some rough rules of thumb on how different lenders may underwrite different things. The next is utilities. So, the gas will be provided by either the gas bills on the property that the vendor will provide you. Water, same thing. Hydro on this building, the tenants actually pay their own hydro and they're separately metered. So there's no real hydroelectric expense. And then there's a section here for other utilities that you may need to enter in, which again, those will be pulled from the bills. Next, we have a property management expense. So again, conventional lender will underwrite you around 4 to 5% under property management. CMHC, anywhere from 3 to 4%. However, you may want to enter in a bit more of a buffer in property management to align with the conventional lender or the lender that you're going to be going with on the acquisition over here. General admin, this is another line item that conventional lenders will generally include in their underwriting assumption. And that's usually about 1%. And it depends, really. Conventional lenders will not include it. CMHC will include it, but it's a percentage of effective gross income. Salaries on the property. So this is just an allocation. It may be applicable to your property. It may not. Snow and lawn. Again, this snow and lawn item might just get grouped into your repairs and maintenance line item over here, or you may want to call it out separately. Same with garbage removal. And then I've given you an option to enter in any other expense that you may have under your deal to just kind of plug in there. So then once you've done that, we have our operating expenses and our net operating income on the property, right? And at the same time, the final step is to enter in what we expect our capital expenditures reserve to be on the property, because and this is just I know when you're on acquisition, you're generally going to have a full-on acquisition capital budget that you're going to be going upgrading various aspects of the property. However, this should just be to maintain just a rough capital expenditures reserve to calculate your cash flow over the period during which you're doing the repositioning of the property. So I've just entered in a rough 3% capex reserve to pull just to take care of capex over the period from when I've acquired this property to when I've refinanced it. So now you've got your full property profit and loss and your net operating income. So the next step is to enter in some assumptions in terms of rent growth, annual expense growth. So this section is really only applicable if you're going to be using this model to underwrite this property as a buy and hold. If you're going to be underwriting this property as a buy and hold, what entering in these assumptions here will do is it'll help to create what I have called here your pre-refinance P&L, and it'll basically show the growth of this is under the assumption that you're just buying the property and you're just going to naturally just hold it over a long period of time. It's basically a turnkey property if you're going to be using this section. If you're not going to be using it as a turnkey property, this section for the most part can be ignored because what will really matter more so is the value that you'll be adding through renovations, through turning over your suites, etc. Okay, so now the next section that we are going to go into is the financing section. So now we've gotten our existing property details, and now we're going to go, how are we going to finance this property? And this is an interesting section. So here you can enter in, okay, well, this is the purchase price that I expect to purchase the property at, $2.1 million. And once this can be tweaked as you go through the whole financing section and you realize, oh, well, I don't have enough money to find, like, this deal is not what it's cracked up to be. I don't have enough financing to pay 2.1 million. Maybe it's actually worth 1.9 million. So what I would do is I would go through the full financing section and then return back once you're done and reassess your purchase price. So I've entered in, okay, I'm going to pay about $2.1 million. That would be about a 5.6% cap rate on acquisition. Now, I've also given the option to enter in land transfer taxes for the property here in the local Ontario market or the Toronto market. However, if you're not purchasing properties in Ontario or in Toronto, you can just enter no for both of these. However, what is convenient here is that this will automatically calculate the land transfer taxes in your closing costs section over here, which is convenient because it's somewhat of a convoluted calculation to go through. However, if you are purchasing a U.S. property, purchasing a property outside of these two markets, you'll have to understand how to calculate the stamp tax or the land transfer tax for your specific market, which there are many online calculators in various markets that can do that for you. Okay, so the next section I have here is vendor take back mortgage. So this property, I know that I will not have enough cash to acquire it full out from my own resources. I know I can't likely will not be able to get financing. However, you can first run the numbers with no VTB mortgage and see how your mortgage will get, how much mortgage financing you'll actually qualify for. And we'll get to that once we get down here. Or you can first assume that what your VTB mortgage you're going to get. And you'll see once we go through down at the bottom, how we can come back to this and reiterate it. So for example, we have a vendor take back mortgage assumption. Right now, we're assuming I'm entering $400,000. The annual interest rate that I'm going to pay that vendor is about 6%. The periodic interest rate, so that just gets calculated based on 6%, is that's a monthly rate. And I believe I had the term there at about, so I've entered in the term for 12 months. The goal here really should be to line up the VTB mortgage term with how long you think it's going to take you to get the property through to fully reposition and refinance. So I like to have this line item here, the time between acquisition and refinance, to line up with my VTB mortgage, because ultimately the goal is to pay out the VTB mortgage with with the proceeds received from a conventional loan. So mortgage, the next step I have here is, will the mortgage be amortized or interest only? I have it entered in interest only here. And then I have, will the interest be paid monthly or accrued at the end of the term? So what this gives you the opportunity to do is also manage your cash flow as well. It'll help you to determine, okay, will my mortgage interest be paid monthly to the vendor, or will it just be added on to the principal every single month and paid at the end of the term? In addition to that, there's also the option to select that the mortgage will be amortized. And if that's selected, this section will automatically appear, and you can enter in, okay, I'm amortizing this VTB mortgage 25 years, and the interest rate will ultimately be the same. However, most of the time, VTB mortgages are interest only, and usually interest is paid monthly. However, you may be able to manage your cash flow better, ask for the interest to just accrue on over a 12-month or 2-year period, and then pay it all out on when you pay out the VTB mortgage. So the next section here, this is also an optional section. So this section is optional if you would like to have the VTB module in the back over here get calculated. And the purpose of this section here is to really help you to present to the vendor of the property what their tax benefit will be by selling the property to you through a VTB mortgage. Now, some of the information here will require you to make some assumptions or speak to the vendor directly, but I think it's very beneficial because it'll help you to generate what the benefit to the vendor is of providing you with a VTB mortgage and deferring their capital gain. So the goal of this is really to show the vendor, I'm getting a benefit by you providing the interim financing. However, you're also getting a benefit through a savings here of a $42,000 savings in taxes as well. So, you always want to kind of present that there. Now, obviously, it will require you to get that information from the vendor. If you're not going to be presenting the vendor with a schedule showing them their tax savings on the VTB mortgage, you could probably just skip through and ignore this section. But I thought it was a nifty tool to be able to show the vendor. So, for example, it will require you to know, okay, what did the vendor purchase the property for? What will their effective tax rate be on the in the year the property was sold? Now, generally, their vendor will probably be in the top marginal tax rate in the year the property was sold because they will have realized quite a large capital gain if they've owned it for a while. So I like to usually assume that they're probably paying the top marginal tax rate in my market. And then what will their tax rate be in the years subsequent to the sale? Now, let's assume I'm making the assumption that their tax rate, they're retiring after the. So the assumption I'm making here is basically that the vendor's tax rate will probably drop after they sell me in the year subsequent to the property sale. Maybe they're retiring. Maybe this was a big cash inflow and they don't really have any other assets that are generating them this kind of income. So that's what I'm kind of doing here. Again, vendor selling costs. I'm making the assumption that generally it's going to cost the vendor about 1% of the purchase price of the property in just selling costs to get the property sold. And then also what I've entered in here is about the commission. So if the deal was purchased off market, what is the commission savings that vendor will have saved? So if I approach this vendor directly and purchase this deal off market, they're obviously not paying a realtor a commission. As a result, they're saving 5% of the purchase price. In my market, it could be 6%. In some markets, could be 4% in other markets, but generally around 5% of the purchase price is saved there. Now, if I'm purchasing this on market with a VTB mortgage, this would ultimately be zero because the commission there is still going to be a commission paid to the broker, and at the same time, so this is just an opportunity to present to the vendor what is the savings that you can generate by selling this property off market to an individual. And then finally, sales tax on commission. So obviously in the jurisdiction I operate in, there is a 13% sales tax on realtor commissions. That would be ultimately, you can enter in the sales tax on the realtor commission in your market as well. And then, what this will do is ultimately it'll generate your monthly VTB mortgage payment. Now, our VTB mortgage section is complete. And the VTB vendor package will also be complete back here, which will basically have a tab showing your payment schedule that you can automatically hand to the vendor when you're negotiating the deal to show them you're going to be earning about $24,000 in interest on this deal just by giving me a VTB mortgage. And it'll automatically calculate where the funds are coming from, whether that be interest or principal, and then the balance to be paid on the disposition of the VTB mortgage or the discharge of the mortgage. And it'll also indicate all the terms, etc. Right? So And in addition to that, you'll also finally, what will get generated here is the summary of the tax savings, which gets calculated in this tax deferral, which I'll go through in a lot more detail in coming minutes. The cash earned on the VTV mortgage, and then also the savings and commission. So as you can see under this deal, I could present this package, which can just be printed out by selecting the tab and pushing Control P. And hand it over to the vendor and say, hey, this is what I'm estimating your savings to you are by giving me a VTB mortgage on this deal. And, $185,000 on this deal, quite sizable. Okay, so the next section we're going to move to is how is basically the primary mortgage on the property, or the acquisition mortgage, which is maybe a repositioning mortgage or a conventional lender mortgage. But basically, we'll be entering the term. So the interest rate, I do have some notes here on how you can kind of estimate your interest rate through a conventional lender by basically taking a spread on the 5-year bond rate, or taking a spread on the CMHC, CMB interest rate. Depends really on what type of mortgage you're getting. But I would talk to your broker and confirm, get an estimate of a reasonable rate to enter in here. Generally, your mortgage will be amortized, but there's also an option to enter in whether the acquisition mortgage is an interest-only mortgage. Because generally a repositioning mortgage will be sometimes interest only to allow you to conserve cash to put towards renovations and whatnot. You can also enter in, will the interest be paid monthly or accrued and paid at the end of the term? So basically accumulated and added to the principal. And then finally, the term, the amortization on the loan, whether that be 25 years. Again, that's not really relevant. If you're going with an interest-only loan, that's irrelevant, right? So, and it'll automatically be blacked out if you select interest only, because you don't have to enter in those terms. But I'm just going to assume we're going to go with more of a traditional amortized loan, 25-year amortization. I'm going to assume a 2% lender fee. And then there's a section here saying lender fee rolled into mortgage or paid on closing. So sometimes the lender will allow their fee to get added to the mortgage principal, and you're basically just paying that down with the mortgage. Or they may require you to pay it as part of your closing costs. So it's important to understand that. So in this section, I'm assuming it's going to get rolled into the mortgage, but if it's going to get paid as part of your closing on the property, you'll select paid on closing, and it'll go into your closing cost schedule up here, which I've kind of already given you there. So I'm just going to select rolled into the mortgage for now. And the next section I have here is the debt service coverage ratio. So now, generally on multifamily deals, there are two components that basically limit the amount of financing the bank will give you on the property. There is obviously, number one, the loan to value on the mortgage, which is, the bank will get an appraisal at the time of acquisition and indicate that, we will advance you, only 75, the property's worth $1 million. We generally only advance about 75% loan to value. Again, depends on your bank, it depends on the lender, but generally the bank will say we'll only advance around 70 to 80% loan to value. But the second limiting factor would also be your debt service coverage ratio. So your DCR, the maximum DCR the bank will allow. Now I have 0.25%. Now this is a general rule of thumb from what I've seen in the market that I operate in, is that, conventional lenders will usually only allow a 1.25 debt service coverage ratio. Some will be a bit more, will allow a 1.1, some will allow 1.2. I'm being a bit more conservative here on acquisition. CMHC will you generally allow a lower debt service coverage ratio, 1.1 on the acquisition, and maybe 1.2 on the refinance. So that's also a limiting factor. So the point of this module is to really help you work within those confines of maximum debt service coverage ratio and also maximum loan to value. And it will take the lower of the two. So basically the lower of the maximum loan the bank will advance using based on your DCR that you've entered in here, and the loan to value. So it may be that your property is worth $1 million and the bank will advance you, bank generally will advance 75% loan to value, but maybe your rents on the property are very, very low and it does not meet their debt service coverage ratio. So it does, there is a bit of override you can do here to kind of get that to where you want to be. But I like to have this in here because it'll really show me what the true limitations of my loan are. So under this situation, I've entered in a 1.25 loan to value, debt service cover maximum DCR, and I generally know that the bank, to be conservative, will only advance me 75% loan to value. So what that means, and then what I've done here is there is a calculation here that is basically taking calculate the maximum DCR that basically the maximum mortgage payment that the bank will allow based on this DCR. So what it's basically doing is it's taking the net operating income that we've calculated up here in this section, dividing it by the 1.25 debt service coverage ratio, and it's pretty much saying your maximum annual mortgage payment will roughly be about $94,659. Now, let's say I found now a lender that will lend to me at 1.1 debt service coverage ratio. I know, okay, well, now that allows the maximum payment to increase to 107. So that's what it's doing. And then basically now that annual payment is just getting converted over to a monthly payment. So now that we know what our monthly and annual payment will be, we know that based on that debt service coverage ratio that I've entered in above, the maximum loan to value, the loan that the bank will advance me on this $2.1 million property is $1.239 million. And at the same time, based on that purchase price and 75% loan to value, if you're based on the loan to value, the bank will only advance 75% loan to value. And so therefore, the maximum amount that the bank will advance to you in terms of your mortgage will be the lesser of the two. The lesser of the amount the bank will advance with respect to debt service coverage ratio, or the maximum the bank will advance with respect to loan to value. Now, obviously, if you're working with a lender, you can play around with these two amounts here to increase or decrease the maximum amount the bank will advance. But I think this is, the more conservative option to go with. So the next section here, what we have is the first mortgage the bank will advance, again, the lesser of the two here, and then the lender fee. Remember up here when I selected that the lender fee would be rolled into the mortgage, that's where it gets rolled in here. So that means your actual total monthly mortgage payment will be $8,046. And what that means is, now that I know the maximum mortgage the bank will advance on my property, I kind of can back into what my down payment will be in the property. So I basically know that I'm purchasing the property at $2.1 million. I'm hoping to get a $400,000 vendor take back mortgage and a $1.239 million first mortgage on the property, at which point that will mean I'll need to put in $460,995 just in down payment, which translates to about a 21.95% down payment on the property. So this has to come through raising capital, through my own resources, through private loans, something like that, to actually finance that $460,000. Now let's say I come to this point here and I say, well, I can't raise $460,000 on this deal. Maybe we start back up here and we adjust the purchase price to reflect that. Now, maybe I don't think that this is a $2.1 million property. It's actually a $1.9 million property. But I still think I could get that $400,000 VTB. And I still think I could get that $1.2 million mortgage. Well, now I only have to put $260,000 into the deal from my own resources. And that maybe is a bit more reasonable. I'm just going to assume that the $2.1 million is a reasonable number and take it from there. Again, you can adjust your down payment up and down, but really I leave it, I have the formula in here so I can just back into the down payment. Some people will think otherwise. Okay, so now that we kind of have our initial financial statements, profit and loss statement entered, and we've gone through all of our financing assumptions, we have what we'd like to call our capital stack on the deal. So we know the property is worth $2.1 million. About 460,000 of that is coming from down payment. 400,000 is coming from a vendor take back mortgage. And then 1.239 is coming from the actual first mortgage, and this is actually excluding the lender fee. So that's where all the money is coming from the purchase of property. Now, obviously, we know that when we purchase multifamily properties, there are very, very heavy closing costs. This would include so obviously we've already calculated our down payment, but we also have an appraisal fee, phase 1 environmental, a phase 2 environmental, an inspection fee, assignment fee if you purchased it off of a wholesaler. There's also legal fees involved, title insurance. Remember previously where I indicated that you would be able to select land transfer tax for the Toronto or Ontario market to be automatically calculated. If you selected yes here, well, that gets calculated right here in your closing costs. Again, if you're in another market, you can just put no there, delete this section out, and then ultimately you can just plug in what your additional stamp tax or whatever would be involved in your area. This section here, mortgage fees paid on closing. So this is the lender fees that you'll be paying on closing if it was rolled into the mortgage, or if it was supposed to be paid on closing. For example, if, as you can see here, remember when we said this could be selected rolled into mortgage? Well, if you select paid on closing instead, now it's going to show up here in your summary of closing costs to get to get the deal done. So that's another nifty trick. And then I've also given some other sections here that that might be specific to your deal that you can kind of enter in. So now, after going through all of these fees, and I know that I need about $511,000 to close on this deal out of pocket day one, just to buy the property, and that's not even including costs to renovate the property, hold the property, refinance the property, etc. So that money will have to be raised. The next section we're going to get into is your renovation budget, or renovation or suite turnover budget. So over here, I have all these sections. Honestly, these sections here, I've given you examples of all components of a building, but you can overwrite these areas and just have them indicate exactly what you specifically are renovating in the property. If you don't want as much of an exhaustive list, then I've also given you an option to put like notes here. And also, I also have the options for you to enter in actuals as you go. So you can, as you do the project, you can compare your budget, what you budgeted for renovations between what you've actually been quoted or what it actually ended up costing you. So in this situation, I'm just going to assume that there was like cash for keys about $70,000, and maybe we're doing a suite renovations of $80,000. Again, those suite renovations can be broken down line by line to kitchen, flooring trim, appliances, framing, electrical, and then there's a whole bunch of other sections here. And you could also enter in a contingency. So just to keep things simple, I just have a $150,000 renovation budget consisting of cash for keys and suite turnover, as well as a notes section here. So now I know it's gonna, in addition to all these closing costs and down payment, I need another $150,000 to probably renovate the property and get it going. Okay, so now that we've completed that section, we're going to move to the next section, and this is the us taking into account the amount of time that we're going to hold the property prior to refinance. Now, if this is just a pure buy and hold, maybe what you want to do is just enter in, 60 months, however many months you think you're going to hold this property for. It could be 10 years, could be 5 years. Convert that over into months, and you can enter that in here, and you'll be good to go. If you if the plan is to more so reposition this property and refinance it, then it'll probably be a shorter term. Like in this property, my estimate is it'll take about 12 months to refinance, to turn over the suites, renovate the suites, and get it ready to go. So I know that in that period, my monthly net operating income on the building is about, which I've entered in the section over here. I know that my monthly net operating income is going to be about 98.60. And how do I get that? That's the NOI, the annual NOI that was calculated when we initially entered in the acquisition P&L on the property down here, divided by 12. And then I know monthly interest on the VTB mortgage, which was calculated over in the VTB mortgage section over here, is about $2,000 a month. So that's the monthly. What the goal of this section is to calculate out our monthly burn on the property. How much cash are we burning every month? The monthly mortgage payment is about $8,050. So that means basically this property loses in terms of cash flow about $186 dollars a month. And yeah, so basically so it's almost a break even during the hold period, which means our burn on the property is not substantial. And then what we have here is this monthly burn divided by the number of months that we are going to hold the property before refinance, and that'll get me my total negative cash flow over the term prior to refinance on the property. Now, what I mentioned before is I like to line up this period here to be in conformance with the refinance of the vendor take back mortgage, because the goal is to ultimately pay back the VTB mortgage with the refinance proceeds. So this is the time. So basically, when you're trying to calculate your time between refinance and buying the property and refinancing it, it's about you'll probably line that up with the VTB mortgage. All right, so the next section. This is the net operating income on the property at refinance. So now this is after we've renovated the property, after we've turned over the units, it's now ready to go, a nice polished property, and it's ready to be appraised and refinanced. So what were we doing here? Well, now we're calculating our P&L post repositioning of the property. So the unit rental revenue, remember this tab over here, the property rent roll, where we entered in what we thought we would be able to convert our rents to after we repositioned the property. Well, that monthly rent amount, or that annual rent amount, is now calculated here, and it's showing up automatically here in our post refinance or our post renovation P&L. Parking revenue, I'm assuming we weren't able to get any additional parking revenue, but in this situation, I assume, okay, well, there is a possibility for storage, $4,000 of additional storage revenue that I was able to add to the property's P&L. There was some lockers on the property that I was able to rent out. Laundry income remained roughly the same. So you can see the total revenue in the property went from what we previously had in this section at about $179,000 per year in gross revenue to now $245,000. Now, at the same time, vacancy, I've left it at about 3%. Again, depending on who you're refinancing with, you may want to take the conventional lender who will generally take a 5% vacancy rate, or CMHC's vacancy rate who will actually calculate it using this portal over here, depending on the property's area. So I have a 3% vacancy rate because I'm assuming this is going to be a CMHC refinanced loan. Property taxes are about the same. They would not have moved. Insurance was about the same. Repairs and maintenance, I have it calculated at about 5% of the effective gross income. Gas bills, again, the gas bill probably about the same. However, you can, plug in whatever you think. If you're able to make the building more efficient, maybe you can put in I can now get it down to $4,000 a month, or maybe I can bill it back to the tenant, and now the gas bill is actually zero. Or maybe same thing with water. The water bill is now zero. So the property obviously becomes more efficient at that point. Property management, that's probably going to stay stable at about 5%, again, depending on your market. I know conventional lenders will generally use 4 to 5% property management. CMHC will use 3% for units below 6 units and below, 4% for 7 units and above. General admin, again, this is not really something that conventional lenders will use, but CMHC will use this. So they'll use a 3% rate for 7 units and above, or 1% for 7 units for below 7 units. Or sorry, 1% for over 7 units and 3% for below 7 units. There's still some lawn maintenance, garbage, and then there's an other expense line item here. Again, you can overwrite these line items with whatever you want in the blue over here if you want to put some additional line items. And basically what we know is that right now the net operating income after refinance on this building is $186,000, which I know. And then what you'll enter in here is the market cap rate. So what is the cap rate that buildings are transacting at in the area? And that'll help you to come up with an implied valuation on the building. Again, you can play around with the cap rate, use a very conservative cap rate, use a very aggressive cap rate to kind of come up with an estimate on what you think the valuation of the building will be. So over here, that net operating income divided by the cap rate will get me to about a $3.2 million valuation on once the building is completely turned over, which is quite substantial. So now that we've completely entered in the post refinance details, well, we also now need to enter in the financing terms on the refinance mortgage. So now we're going to refinance our mortgage. We know our interest rate. Let's just assume it's going to be 6%. Again, I have some information here in this cell to kind of help you, guide you through how maybe you might want to estimate your rate. But the best thing to do is just to go to your mortgage broker and ask them what they're seeing in the market. The terms of the loan, it will probably be an amortized loan on refinance, but there is an option for interest only. Amortization, I have a 25-year amortization here. If you are going with CMHC or other government insured programs, it might be a 40 or 50-year amortization. My assumption here is, let's just assume now maybe we're going with a 30-year or maybe 40-year amortization with CMHC. It's obviously going to help your numbers quite a bit. The number of periods, that automatically just gets calculated as 40 times 12. And then the lender fee, I'm assuming there's a 2% lender fee here. That might not be the case with the loan that you're going for. There may not be any lender fee at all on the underwriting. But CMHC, this will either be your lender fee or your CMHC fee, depending on the lender that you're using, right? And CMHC will roll that into the mortgage. So they'll usually take something closer to about a 4% lender fee, depending on the leverage point that you're going for. Again, those rates change all the time. So you'll have to talk with your broker and ask them what is the lender fee or that they'll be taking, or the mortgage insurance fee. Again, similar to how we calculated our maximum mortgage amount, we now know that on the refinance, speaking with the lender, that we are capped at a 1.2 times debt service coverage ratio, and the bank will only finance a maximum of 75% loan to value. Now, I know with some government insured housing programs, the government may lend you 85% loan to value, 95% loan to value. But at the same time, you'll always be capped by your debt service coverage ratio. So even if the program says that they will advance you 95%, if you have not raised your the cash flow on the property enough, you will still be capped. Now, some lenders may go down to like a 1 or 1.1 times debt service coverage ratio, but I'm being conservative here. Maximum annual mortgage amount. So similar, exact same way that we calculated the maximum mortgage amount in the previous section, it's being calculated here on the refinance. So same way we calculated on the acquisition, it's being calculated on the refinance. We have basically the net operating income on the property divided by 1.2 will get you the maximum annual mortgage payments the bank will permit. Convert that over to a monthly rate. So we know that using our present value calculation, the bank will only advance us a $2.3 million mortgage on the property, or sorry, the lesser of the 2.3 million that they'll advance based on the debt service coverage ratio, or the 75% loan to value, which we calculated down here based on the net operating income divided by the cap rate. So that's 75 or 75% of the 3.2 million, the lesser of the two. So generally, as is the case with many loans, you're capped at your debt service, your DCR. So it's taking the lower of the two. And then the lender fee, which is going to get rolled into the mortgage right here, which will then convert that into your monthly mortgage payment. So I just have, again, another like kind of rule of thumb DCR table down here. You don't have to use it. You can maybe sit down with your broker in your market and understand and ask them. But I know now my first mortgage is going to be about $2.3 million. So now is the part that everyone tends to enjoy. We're going to now try to see how much of our original investment is left in the deal. So I call this profit on refinance. Maybe you might want to call it cash proceeds returned to you on refinance. But the way that the calculation works is we know that we now will have a $2.3 million mortgage advanced to us on refinance. We have to discharge the original bank mortgage of $1.2 million on acquisition. But at the same time, over that 12-month period, we paid down $22,000 of the of that mortgage, of that $1.2 million mortgage, which we have to get credit for. So now we have refinance proceeds of $1.145 million. So that's basically what's going to come to us in our pocket on refinance. But guess what? We still have to pay back the $400,000 vendor take-back mortgage. We also have to pay back interest on that VTB mortgage, whether it was paid monthly throughout the term of the loan, or whether that was paid all at once in a balloon payment. Principal repaid on the VTB mortgage because it was interest only. There was no principal paid. There's also the original down payment, closing costs, and due diligence costs of $510,000 that was calculated in this section over here, where we calculated what we would need, basically the cash required for closing. There's also the $150,000 renovation / suite turnover cost, and then the $228 negative cash flow during the deal. I've also given some other sections here. I always like to leave sections for other things that are not necessarily included that you can manually plug in. If there was like an other cost of like, a mortgage termination penalty of $10,000, maybe you want to, or $100,000, maybe you want to enter that in there. You'd enter that in actually as that cost in there as a negative, because that'll be negative to you, right? You're going to have to pay that cost out. So it's going to enter it here. It'll be entered in as a negative. Maybe I also have to back out some other like, $5,000 in admin fees, back that out. But let's just assume that those costs are not actually there. Finally, we come to our line. How much cash is returned to the investors on refinance? So the building is fully refinanced and optimized. In this, we have our entire original investment returned to our investors plus $58,000. So we have a $58,000 profit on refinance that's distributed out, and we are holding an asset now that is fully turned over and renovated. So I think that's that would be a successful deal, I would say, because there's none of our own money left in the deal. Plus, we've distributed $60,000 back to our partners. And now we're also coming to a point here where we're going to calculate our annual cash flow on the deal. So we know, based on the P&L that we generated over there, our net operating income is $186,000 a year. Now we have to back out the annual mortgage payments. So there's both annual and monthly numbers here. So annually, we're paying about $159,000 in mortgage payments. That includes principal and interest. We also have the option now. I would enter in, this is the capital expenditure reserve. So I'm entering a 2% capex reserve, assuming that I renovated the building and for the most part it's in good shape. And this is just kind of set aside. So our true cash flow on the deal is about $31,000 per year. Plus we have $60,000 back in our pocket after the refinance. And now that's the cash flow basically on day one. And cash on cash return percentage, well, because we don't have any money left in the deal, the cash on cash return is quite frankly infinite. That's why it says no cash return remaining in the deal. Now, let's just say there was a $200,000 additional cost in there. Well, then this will now get calculated at a cash on cash return of 23%. Because now we actually have $141,000 left in the deal. But for this deal, there was no cash remaining in the deal. And I've also given some other line items that you can enter in to plug in some other items that might not be included in your NOI, but are below your NOI line to get to your annual cash flow number. Okay, so now we're approaching the final input section, the final real input section. This section is for generating your 10-year projected profit and loss statement. So over here, there is a 10-year projected P&L on the property, basically showing how the property will grow rents over time, how expenses will change over time. The point of this section here is really for you to just kind of enter in, okay, what percentage do I think these line items will grow? Like I know in my market, rents do grow quite quickly, maybe around 4%, 5%, but the government will limit the amount of rent increases to around 2% a year. So I'm just entering it in conservatively that I'm going to grow, all my rent line items at 2%. Now you may say like, okay, well, I'm going to increase my rent line item at 2% a year, but maybe storage or laundry, I'll increase at 5% a year. Maybe my laundry rates, I'll increase at 10% a year, and then, all the other revenue line items that you plugged in here. Like the good news is like this says other revenue, but as you enter in other sources of revenue here, that field will automatically get updated. Let's just say like you're making some advertising revenue from a billboard on your building that of like $1,000 a year. You can enter that in here, and then automatically that title will show up over here, right? Anyway, so continuing on, you can enter in the percentage growth of each one of those line items, and then also the percentage growth in each one of those expenses. I'm making a very general assumption that expenses will grow at the rate of the long-term inflation rate of like 2%. You may want to assume that capex reserve maybe should increase at a 4 or 5%. Great. Utilities maybe you've noticed in the past they increased at 6 or 7. I mean, this is all for you to underwrite and help to create a projected financial statement. And I think it looks very professional when you're able to come to your bank or your lender and say, listen, I've completely completed the refinance on this deal. This is my 10-year projected P&L. I don't think anyone ever that I've seen it presents a 10-year projected P&L and is able to generate one as nimbly as this. As you change your expenses, you're able to grow, you're able to have an automated 10-year projected P&L, and you can see how that impacts all of your property ratios, which I'll go through this in a lot more detail when I do the full tab review. Okay, so now we've finished all of our inputs. Now, this section over here is just kind of what I like to call the investment summary section. It kind of shows you the 5-year and 10-year returns on the deal. How much mortgage you're getting paid down, how much cash flow you're generating, what your total appreciation will be. So appreciation, again, on the property is really dependent on the amount that you're growing your NOI because of this is a multifamily deal. So it's not a percentage appreciation rate. It's it's the percentage in which you're growing your NOI on the property. And then obviously your return on investment, your debt service coverage ratio after 5 years and your debt service coverage ratio after 10 years. You may ask, why does that matter? Well, the lender will cap you out at a maximum debt service coverage ratio. So if your DCR is growing on the property, that means you can probably go and refinance more capital out of the deal. It'll also give you your net operating income over at the end of the 5-year period or at the end of the 10-year period to show you how much it's grown. It'll also give you a summary of the initial capital. So this is a summary of the total capital needed to do the deal. And then it's a summary of the long-term capital that will be left in the deal. So based on our assumptions here, we know that we needed that about 500 and change to purchase the property, another 150 and change to do the renovations. And that roughly came out to about $687,000 in total capital that will need to be raised from investors to do the deal. But good news is that there's no money left in the deal once it's done. Now, because this deal had no money left in the deal, the ROI was actually infinite. Like I said, let's say when we refinanced the deal, there was an additional cost of $200,000. These amounts will get calculated now, and you can see the average annual ROI on this deal is about 30%. Once you get to the 10-year term, you'll see that it's actually closer to 72%, which is quite impressive of an investment. And then there's also a summary here of all of your capital sources and uses. You can see over here, you can see where all the money went. So the down payment, the closing costs, the renovations, the holding costs, the interest paid on the VTB mortgage. This was the equity required from you, the $687,000. Then there was the vendor take back mortgage that had to be that was used as a source, and the first mortgage. So you know that the total money to do this deal was about $2.3 million. Okay, so next I'm going to go into a couple of the tabs that are now generated. Now that we've gone through all of the details on the inputs tab, we can see how dynamic this model is, how quickly and easily tweaking one assumption can give us so many new reports and automatic. Now, I'll start off, you have your cover page here. This is just really, your property address will automatically get updated as you plug it into the inputs tab. And you can you'll have to manually copy and paste in a picture of the property or a picture of your, what you want included in the cover page. Next, there's also an executive summary that gets produced. So this is a really, really quick summary of the deal. If somebody asks me, show me this deal in one page in a snapshot, this is what you would show them. Like you'd show them the acquisition. I'm going to buy this property for $2.1 million. I'm going to have to put about $49,000 in closing costs. And this is how much the total, including closing costs, is going to cost me. This is where the financing is coming from. This is where these are all the additional costs, the closing costs, the renovation costs, the holding costs, and then that's the total capital required. How much of the money is coming from equity? How much of the money is coming from VTB mortgage? How much of the money is coming from first mortgage? So you have your total capital sources and your total capital uses. So your total capital uses and your total capital sources here. Next, just a quick summary of your renovation budget, your renovation timeline, and your estimated after repair value. And the next section here will show this is what my very summarized P&L of my deal looks like at acquisition. This is a summarized version of my P&L at refinance. So I've been able to grow the net operating income from $118,000 to about $186,000. And this is the change in the financing costs post refinance and the change in the cash flow post refinance. Now think about it, you don't really have much money left in the deal at this point. And then your cash flow over 5 years and 10 years, and your cash flow and your mortgage principal paid down over 5 years and 10 years. And then this is really the summary of the deal shown here. Your after repair value, how the mortgage is getting discharged out, repayment of the VTB mortgage, and basically showing you how much money is left in the deal once you're ultimately done. The next thing, this is the acquisition summary. So what I would call this is the full detailed investment summary here. So kind of giving taking the executive summary, I guess, to the next step. Now, maybe they want to see the full plan for the property. Well, here's the purchase price, the capital needed, the long-term capital invested. Here's all of my closing costs that are automatically generated. Here's the summary of how the vendor take-back mortgage is getting financed. Here's a summary of how I'm financing my first mortgage. Quick summary of the P&L at acquisition and at refinance. Here's my full renovation budget. Again, if you don't have this detailed of renovation budget, you can choose to just highlight these sections, right click and click hide. And this will just get, ultimately, it'll just get hidden. So you don't have to, show all these empty lines. Next, it'll also show you here are all my post-refinance mortgage terms. So we have my pre-refinance mortgage terms. This is all my terms post-refinance. Here's the total capital required. Here's the total capital return on the refinance of the deal. I'm just going to zero up this section quickly, just to go and show you that we returned $58,000 to the investors, and then 5 years of projected returns on the deal. So quickly, these are, what I would call the projected returns, what we think this property will actually return over that 5-year period. Effective gross income, showing how it's going to grow. Net operating income, how is that going to grow? Cash flow, how is that going to grow? Cash on cash return, operating expenses, showing how your debt service coverage ratio will grow. Showing how and then ultimately showing your return on investment, assuming no appreciation in each year. Your return on investment showing with appreciation, all of that. It will also show you your 10-year projected profit and loss statement. So here is now to caveat the P&L. This is your profit and loss statement post refinance. And it's also showing you, your assumptions in terms of, revenue and expense inflation assumptions here. Now, what the model will also do is it will generate your profit and loss statement in this section over here, the pre-refinance package, just for the term that you're the initial term. So the initial term that you acquired a property. So remember the initial 12 months that we bought this property for? Well, it's going to basically calculate what is basically what is our P&L going to look like for the 2 year, maybe the year or 2 years that we're repositioning the property. It's probably not great in the initial 2 years. The annual cash flow is about a negative, but you'll be able to show your investor here, this is what during the 2 year repositioning period, our P&L will look like. And then here is what the 10-year projected, if this goes out to 10 years because, sorry, the pre-refinance one goes out to 10 years because this will be used more so if you're not, if the plan is just to buy and hold the property, well, you don't really have to go through the whole refinance section of the model, right? You can just cut it off at the acquisition and entering your initial P&L and enter in your rent increase assumptions. So remember, and your revenue and expense increase assumptions. So remember when we initially were going through the acquisition section over here, I had revenue and expense growth percentages. The reason why we have this here ultimately 2 times, one on the acquisition and one in the section for refinance over here, is because if you just wanted to buy a property and hold it, you can just automatically, generate, you can just change your term over your term between acquisition and refinance here to, whatever 600 months, and that'll get you to about 12 years. And And basically at that in that situation, you'll be able to just generate a buy and hold P&L on the property, and you'll be able to enter, use these gross revenue gross assumptions. So that's why we have a pre refinance P&L section over here. Okay, so just to continue on, we went through our investor summary, our 10-year projected P&L. I've also given you a section here to enter notes if you want to have notes for your potential clients. Amortization table. This is our amortization table is now automatically generated the post refinance amortization table is automatically generated here. You can see how much interest is being paid with each payment, how much principal is being paid with each payment, the terms. So you can quickly turn around to your lender or your client, and you can show them actually what the amortization table looks like for the deal. Stats and graphs. This will all automatically, now once you've done all that, it'll automatically generate financing sources at acquisition, uses of the equity that the investor is going to have to contribute to the deal, how the investment, the post refinance return. So how your annual cash flow is going to change, how your return on investment is going to change each year with appreciation and without appreciation. And also one of my favorites is how your debt service coverage ratio is going to grow over a 10-year time horizon. I also have a section here where you can enter in property images pre-renovation and post-renovation. So you can just take your images of the property, copy and paste them here and configure them in any way that you want. And you'll have that option to also include that into your package. So now let's say we want to just quickly print this out into a nice PDF that looks something similar to this. So once you have entered in all your information, you're going to get a nice PDF that can be generated basically like this, showing the summary of the deal, all the returns, the 10-year projected P&L, all of the graphs, the stats. You can even include your property images. You can include your amortization table. What you'll do is you can select the tabs that you want to print. So you select the tab, push Control on your keyboard, and select the tabs that you actually want generated in your PDF, and then you put them in the order that you want them printed. So let's say I want all of them printed. I will select Control on my keyboard and select the tab and push Control P, and basically you'll see that the PDF will get generated, and you can print it to PDF, print it to Microsoft PDF to generate the report. I mean, if there are some tabs you don't want included, you can just skip them over. Let's say I don't want the executive summary included for whatever reason. I'll skip over that and I'll just go to my post refinance tabs and whatnot. If say I want the rent roll included, I can move the rent roll over to wherever I want it included in my printout, and also print the rent roll as well on the property. So, okay, so pre-refinance. So again, like I mentioned, this section, it can be included in your full package, or you can generate a pack. This can be used as a sort of buy and hold multifamily package. So that's why I want the flexibility. The model has the flexibility to keep this as a buy and hold deal as well. And you can see it'll generate this is the pre-refinance package can be used as a buy and hold deal, or it can also be used to show your investor, okay, well, this is my plan, what the property's P&L is going to look like for the first year or 2 years while I'm renovating the property, and then I'm going to refinance out. But this is maybe to show the burn. And this section here, investor summary, is more of a truncated version of the other investor summary I showed you, just to show what the deal would look like just as a buy and hold, and not using repositioning. And then it'll also show you what your mortgage amortization table, automatically generate your mortgage amortization table on the original loan. So this one over here will be the mortgage amortization table. Like the section over here that I previously showed you would be the amortization table after you've refinanced. If you want to see what your amortization table looks prior to refinance on the mortgage you got on the property, not the VTB mortgage, but the conventional loan, it will be here. I also have the VTB mortgage section over here as well. So this is also a package that you can provide to your to the owner of the property to show them the vendor take back mortgage that and the benefits to giving you a vendor take back mortgage. So first off, I think what is nice is you can actually show him this schedule right here, this amortization table or the payment schedule, depending on the terms of the loan, and show him, well, if you give me a VTB mortgage over 1 year, not only are you going to sell me the property at this price, you're going to earn $24,000 in interest on the property, which is quite lucrative to you as well. So you're generating an additional source of income almost risk-free. And you know, at the end of the day, you're secured on the property, and you can see here in the schedule, the VTB mortgage is paid out after 12 months. Now, let's say if we go back to the analyzer tab, and in the VTB mortgage section, we selected instead of interest only, we said that instead of interest paid monthly, we said the interest was accrued and paid at the end of the term. Well, now our payment schedule we can quickly show the vendor, well, you know, you're going to now be earning, if you give me a interest payment that is just, if you give me a loan where the interest just accrues, well, you're going to earn an extra $671 because you're earning compound interest on basically interest on interest, right? Where the interest gets added to the principal each month. So you could show him that way as well, depending on how he would prefer. Maybe he does, you know, from a tax perspective, the vendor may not want to be earning these monthly interest payments because they're in a high tax year. So from their perspective, you may want to convince them that, hey, like, actually, you probably don't want to make this interest on your VTB mortgage in cash payments. You actually want to earn it through, you want it to be paid out as a balloon payment at the end of the loan, so that you can defer the income into a lower tax year. That's just another opportunity to go through there. So that's just an option. I'm just going to undo what I just did over here, and we're going to continue going through the VTB summary. So the next section is calculating the the savings on the tax deferral from the VTB mortgage. Now, what many people don't know is that by giving you a VTB mortgage, the vendor realizes somewhat of a tax savings because they're deferring their capital gain into another fiscal year. So you can see the sale price, like over here, this schedule will automatically get generated based on the VTB mortgage details that we entered in the other tab. Now, like I said, there was an optional section in the VTB mortgage section over here where you can enter it, like, you know, this may be information you will have or you don't have. But if this is really an optional section, if you're going to be like presenting the vendor what their potential tax savings will be, but it will require you to know what they bought the property for and some maybe more personal details like their income tax rate in the year of sale and subsequent after that. It'll also maybe require you to understand if you're buying off market, that what the commission will be and what the sales tax will be. But I think it's nevertheless like a good representation, or it may not be 100% accurate, but it will be maybe a good representation to the vendor to show them like visualize the savings they'll realize through a VTB mortgage. Like I said, so for the vendor, we you know, there's what they bought they're going to sell the property for, what they bought the property for. Again, this is all automatically generated based on the inputs tab. This is their profit on the sale, and then less the closing costs. You've entered in the closing costs in the one-page deal analyzer. I have it at 1%. However, you know, if they're closing this on market, their closing costs will probably be closer to 6% because they'll pay a 5% realtor commission on the deal. And then I also have the capital gains inclusion rate. So basically after that, there's about a $1.579 million capital gain. Capital gains inclusion rate is generally 50%. That's a taxable capital gain of $789,000. of which 53.5% is taxed in the year of sale. So because they're realizing such a large gain, they're going to be taxed at the top marginal tax rate in the year of sale at about $422,000. Now, there's a bit of nuance here in terms of tax rate. Talk to your accountants on how this should actually be calculated, but it's a good generalization. Next, we're going to go into say, okay, what if we ended up giving you ended up giving me the VTB mortgage that I'm asking for? Well, I need a VTB mortgage on this property of let's say I think I have about $400,000, which I entered in the one-page deal analyzer tab. It's still the same calculation. There's still that taxable capital gain of $789,000, but in addition to that, there's a VTB mortgage amount of $400,000 that now I'm requesting that they give me for a 12-month term, which would ultimately result in the capital 400,000 sorry, a portion of the capital gain getting deferred to the next fiscal year. So ultimately of the $1.2 million sale price, 1.7 will be received by the vendor in the year of the sale. And then, we're assuming in the year of sale, because they're the top marginal tax rate, their rate is about 53%, but in the next year, they'll be taxed at about a 25% tax rate. So now we have this schedule over here that's calculating when their capital gain or how the capital gain will be their tax savings in the event of them granting a vendor take back mortgage. So as you can see, in year one, basically they're receiving 1.7 million. The total taxable capital gain again was $789,000. However, they're able to keep a capital gains reserve set aside. So about 150,000 of that income on the VTB mortgage of that, so 150,000 of that 789,000 is now sheltered through a capital gains reserve, and it's going to get pushed to the next year. So the bigger the VTB mortgage they give me, the more of the capital gain can be pushed to another fiscal year. So if they instead, I can now say, hey, Mr. Seller, instead of giving me a $400,000 VTB mortgage, I know that you basically don't have a mortgage on this property. How about you give me $1 million VTB mortgage, right? Do you really want to pay all of these taxes in this year, or do you want to push those taxes out to next year? And then what we can say next, then we'll go back to our VTB mortgage schedule, our deferral, or VTB mortgage deferral, and we'll basically show him, well, now instead of you sheltering, having a capital gains reserve of 150,000 that I previously showed you, your capital gains reserve, so now of that $789,000 taxable capital gain, 375,000 of that is going to be sheltered into the next year, which is great for you, Mr. Seller, because you're not going to pay the taxes. You're not going to pay taxes on the full amount this year. You're going to pay it next year. Now, there's some nuance here because their tax rate may change because you're pushing more income to the next year. But you could ultimately, what I'm trying to demonstrate here is that you can show through this schedule that the seller will now pay, have about $413,000 of taxable capital gains in this year and $375,000 in taxable capital gains next year. At the same time, there maybe they want to say, okay, well, I don't want to pay it next year. I want to pay in year 3. Well, then you can say, well, yes, Mr. Seller, that's great. I can definitely adjust the term of the VTB mortgage. Maybe instead of 12 months, you give me a 24-month VTB mortgage on the loan, and I'll just enter that into my VTB mortgage section. And we can show him now, well, okay, then that means if you give me a 24-month, you're not going to pay the taxes. You're only going to pay about $221,000 in taxes this year. You're not going to pay any taxes next year, and you're going to pay $93,000 in taxes in 3 years when I pay out the VTB mortgage. Is that make you more comfortable? And you can work around work with the vendor to work around his tax planning situation to allow him to show him, okay, well, this is going to be the tax rate in the year that the VTB mortgage is paid back. Maybe he's making a lot of money in year 1, 2, and 3, and he doesn't want to pay taxes in that year. But year 4, he's got no other income coming in, and that's the year that you want to pay. He wants to pay the taxes. Well, you can adjust your term accordingly. Again, this is basically calculating exactly. There's the formula down here where you can analyze how capital gain reserve is calculated and how you can, basically the lender can defer their capital gain. But basically, what you're trying to do here is to show the lender that they're deferring the gains that they're paying. And because, they're in this situation, the vendor is deferring the gains, that the capital gains that they're paying into a year where they're in a lower tax bracket. There is obviously, you could see that there was a substantial tax savings, about $107,000 if we were to be given a $1 million VTB mortgage. Now, I'm going to go back to the original $400,000 VTB mortgage that we had in our original schedule. But that's just a quick demonstration on how growing the you can quickly dynamically show the vendor how the VTB how they can defer their gain and how they can realize a tax advantage situation by delaying their their capital gain, and at the same time or move around the gains into a year. Maybe they've sold all their properties in this current year and they have a huge amount of income coming in. They maybe want to defer that gain to year 3 or year 4 and pay a lower tax rate. Anyway, so over here, the tax savings is calculated through the VTB mortgage. You can talk to your accountant, work with them as well. But I think this is a good tool to use. And then ultimately, there's this summary. So what you might want to do is just print this summary off for your vendor, select these 3 tabs, push Control P, and it'll generate a PDF of what the VTB mortgage savings will be, and then from a tax perspective, and also the payment schedule to the lender, to them as well. So what you have here now is you can go to the seller at the end and say, well, you're going to save $42,000 in taxes by getting me a VTB mortgage. You're going to earn $24,000 in additional interest by giving me the VTB mortgage. You're also saving 5% in commissions because you're selling me this deal off market. Now, and you're saving 13% on that commission in sales taxes. So that's also an interesting point, is that they're saving basically a substantial commission and they maybe can adjust the purchase price to reflect the tax savings. Now, the way that this 5% was generated, you can, again, in the VTB mortgage section, we had this little section here where we would enter in the vendor selling price as a percentage of the sale price. Now, if they're selling it on market with a realtor, they're probably going to pay 6%, 1% in closing costs and 5% in commission. So that'll be 6%. And this section here is if the deal is purchased off market, the sales commission. Now they're saving a 5% sales commission by purchasing the deal off market. Maybe you approach them directly and you can say that, because you're selling this off market to me, you're going to basically you're saving that 5%. Maybe translate that into a cut in the value of the deal. Now, finally, I have a couple additional sections here where you might want to go through some clauses. These are some clauses, some due diligence clauses that you'll have on the purchase of a multifamily building, a quick due diligence checklist, that maybe a bunch of documents you might want to obtain. Yeah, and ultimately, that is a summary of how to use the multifamily investment model, how to create your one-page deal analyzer. Personally, I really enjoy this one-page deal analyzer because it allows you to view your whole deal in one place and really tweak your variables quite dynamically and regenerate your whole report and view things in a from very different perspective, in various views, just by changing one variable here. And sometimes I like to just print out this whole tab right here and just have the whole deal on one big sheet of paper and kind of show it to somebody. It's the giant executive summary, I guess I'll call it, or just use it as your input sheet. But it's really cool to be able to generate all of these different types of reports, and you know, you can mix and match them however you want, right? You can, like I said, pre-refinance package can be used just as like a buy and hold package, and you'll have a longer holding term. Um, you have vendor take back mortgage summary, or just a full like mortgage repositioning summary. So thanks again for attending this session. And I look forward to any feedback.